Hi, everyone. Welcome to the July 2022 Market Outlook brought to you by 12 Points. Last week, we got June's CPI report, and it printed a hot number at 9.1. The good news is core CPI actually fell slightly. This leads us to believe that potentially we're reaching peak inflation and that we could have some deflationary forces in the future that not only benefit the economy, but allows the Federal Reserve's path to become easier as we tighten financial conditions and raise interest rates to combat inflation. Besides the CPI report, there's been a number of soft commodities that have come down significantly in price. Oil is down 8%, oats are down 6%, corn is down 5%, lumber is down 5%, wheat is down 3%, copper is down 5%, and the yield on the 10-year US note is down 12 basis points. We're also seeing some cooling off in the housing market. The number of active US listings jumped 18.7% year over year in June. It was the largest annual increase going back to 2017. New sellers entered the market at a faster rate than before pandemic housing rally began, and buyers are now facing nearly 3% higher mortgage rates. So we're seeing some cooling off in the housing market, which should also bring down inflation. We're also seeing used car prices that have declined significantly over the last few weeks. So we're not ready to say that we've reached peak inflation, but we do think that the worst part of it is behind us. And again, if it is, then the path for the Federal Reserve has probably just become easier. Going forward, all eyes will be on second quarter GDP, which we'll be getting later this month. We are expecting a negative contraction print, which could define us as being in a recession. Now, when we throw the word recession out there, I know there's been a lot of talk around there about what that could potentially mean to the economy and to your portfolios. We believe that it's going to be a mild and brief recession. And we're actually seeing that kind of play out now with consumer spending, which was up 10% in the first 2 weeks of July. So the consumer stays strong, and we know that we have a pent up savings across the country. So that leads us to believe that we can actually manage through this recession, and it won't be as dire as previous recessions like '08 in 2000 and even the Great Depression. What we needed to see happen is a valuation reset, which has occurred. And sentiment is now broadly negative, while economic and profit expectations have slightly retreated. We will get a better understanding as we are now in earnings season. Last week, we let it off with the banks on July 13th with JP Morgan kicking off the show. Now, the banks' earnings were actually very healthy and they looked very good. So we still believe that we can manage through this recession and that most of the pain has actually already been priced into the market. And we're actually slightly more bullish here and thinks that stocks have an opportunity to run. We are still invested in a rising rate and inflationary environment, but it looks like that tide could be turning faster than people expect. And the bond market is actually telling you that there is a potential for rate cuts in 2023. That would make sense is if we do hit a slow patch and recession is here with us, the Fed as well as other central banks around the world will have to loosen up policy to stimulate growth. Now, the other thing we want to leave you with is history indicates that after large drawdowns, as seen so far in 2022, represent opportunities and are often the precursor to a meaningful rebound in equity prices. It's not just that. As a further example of negative sentiment, Bank of America's bull bear indicator hit zero 2 weeks ago. The last few times this occurred was in August 2002, July 2008, September 2011, September 2015, January 2016, and March 2020. All periods that it paid to own equities. And one last statistic that I would like to leave you with is we do have a midterm election coming up that will take place in November. In the 25 midterm years since 1930, S&P 500 has been down in 10 of those years through the election eve. In the 12-month period after midterm elections since 1950, the S&P has never, ever been down. And the average gain following that period is 14.5%. And in the average gain, if the midterm election happens in a year where we have a bear market, the average return is actually 28%. So we're not ready to say that we're starting the leg of a new bull market, but we don't think that the pain that mainstream media is putting out there is necessarily warranted. We do think that we can manage through this recession and that it will be mild and brief and that it will actually pay to own equities over the next coming months as we're probably looking at projections of rate cuts in 2023. Besides earnings, it should be a fairly quiet summer. And I think that we will remain, in a volatile market up until and through this year as people are expecting a recession and as we continue to see the whipsaws in oil prices and energy prices. Um, but at the same time, the US is in far better position than anywhere else in the world. And we do think that capital will continue to come here. That's it for this month. We hope to hear from you and we look forward to answering any questions that you may have. Take care.